Welcome to our channel. Today, we're diving deep into the world of investing with a comprehensive guide to mastering the stock market. Whether you're a seasoned investor or just starting out, understanding the fundamental principles is crucial for success. In this video, we'll uncover the top 10 key principles that every successful stock market investor should know. Today, we will talk about the 10 key principles of successful stock market investing. So before we get started, make sure to hit the like button. Also subscribe to my channel. In the stock market, there is no rule without an exception. There are some principles that are tough to dispute. Here are 10 general principles to help investors get a better grasp of how to approach the market from a long-term view. Every point embodies some fundamental concept every investor should know. 1. Ride the winners, not the losers. Time and time again, investors take profits by selling their appreciated investments, but they hold on to stocks that have declined in the hope of a rebound. If an investor doesn't know when it's time to let go of hopeless stocks, he or she can, in the worst-case scenario, see the stock sink to the point where it is almost worthless. Of course, the idea of holding on to high-quality investments while selling the poor ones is great in theory, but hard to put into practice. The following information might help. Riding a winner. The theory is that much of your overall success will be due to a small number of stocks in your portfolio that return big. If you have a personal policy to sell after a stock has increased by a certain multiple, say 3 for instance, you may never fully ride out a winner. No one in the history of investing with a sell after I have tripled my money mentality has ever had a 10-bagger. Selling a loser, there is no guarantee that a stock will bounce back after a decline. While it's important not to underestimate good stocks, it's equally important to be realistic about investments that are performing badly. Recognizing your losers is hard because it's also an acknowledgement of your mistake. In both cases, the point is to judge companies on their merits according to your research. In each situation, you still have to decide whether a price justifies future potential. Just remember not to let your fears limit your returns or inflate your losses. 2. Avoid chasing hot tips. Whether the tip comes from your brother, your cousin, your neighbor, or even your broker, you shouldn't accept it as law. When you make an investment, it's important you know the reasons for doing so. Get into the basics by doing research and analysis of any company before you even consider investing your hard-earned money. Relying on a tidbit of information from someone else is not only an attempt at taking the easy way out, it's also a type of gambling. Sure, with some luck, tips sometimes pan out, but they will never make you an informed investor, which is what you need to be successful in the long run. Find out what you should pay attention to and what you should ignore. 3. Don't sweat on the small stuff. As a long-term investor, you shouldn't panic when your investments experience short-term movements. When tracking the activities of your investments, you should look at the big picture. Remember to be confident in the quality of your investments rather than nervous about the inevitable volatility of the short term. Also, don't overemphasize the few bucks difference you might save from using a limit versus market order. Active traders will use these day-to-day and even minute-to-minute fluctuations as a way to make gains. But the gains of a long-term investor come from a completely different market movement, the one that occurs over many years. So keep your focus on developing your overall investment philosophy by educating yourself. 4. Don't overemphasize the P/E ratio. Investors often place too much importance on the price-earnings ratio, P/E ratio, because it is one key tool among many. Using only this ratio to make buy or sell decisions is dangerous and ill-advised. The P/E ratio must be interpreted within a context, and it should be used in conjunction with other analytical processes. So a low P/E ratio doesn't necessarily mean a security is undervalued, nor does a high P/E ratio necessarily mean a company is overvalued. 5. Resist the lure of penny stocks. A common misconception is that there is less to lose in buying a low-price stock. But whether you buy OR's 5 stock that plunges to R's 0 or OR's 75 stock that does the same, either way you've lost 100% of your initial investment. A lousy R's 5 company has just as much downside risk as a lousy R's 75 company. In fact, A penny stock is probably riskier than a company with a higher share price, which would have more regulations placed on it. 6. Pick a strategy and stick with it. Different people use different methods to pick stocks and fulfill investing goals. There are many ways to be successful, and no one strategy is inherently better than any other. However, once you find your style, stick with it. An investor who flounders between different stock-picking strategies will probably experience the worst, rather than the best of each. Constantly switching strategies effectively makes you a market timer, and this is definitely most investors should avoid. 7. Focus on the future. The tough part about investing is that we are trying to make informed decisions based on things that have yet to happen. It's important to keep in mind that even though we use past data as an indication of things to come, it's what happens in the future that matters most. 8. Adopt a long-term perspective. Large short-term profits can often entice those who are new to the market. But adopting a long-term horizon and dismissing the get in, get out, and make a killing mentality is a must for any investor. This doesn't mean that it's impossible to make money by actively trading in the short term. But, as we already mentioned, investing and trading are very different ways of making gains from the market. Trading involves very different risks that buy and hold investors don't experience. As such, active trading requires certain specialized skills. Neither investing style is necessarily better than the other, both have their pros and cons. But active trading can be wrong for someone without the appropriate time, financial resources, education, and desire. 9. Be open-minded. Many great companies are household names, but many good investments are not household names. Thousands of smaller companies have the potential to turn into the large blue chips of tomorrow. In fact, historically, small caps have had greater returns than large caps over the decades. This is not to suggest that you should devote your entire portfolio to small cap stocks. Rather, understand that there are many great companies beyond those in the small cap index, and that by neglecting all these lesser-known companies, you could also be neglecting some of the biggest gains. 10. Don't miss to diversify your equity portfolio. It's always wise to have stocks from different sectors and industries. Do not expose yourself to many stocks for the same sector. Most of the companies from capital goods and infrastructure sector have not performed since last 6 to 7 years, but private banking stocks, NBFCs, consumers and automobile companies stocks are making new all-time highs. Hence, it's important to stay diversified with your stock investments. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.